G'day and welcome to this week's podcast of the Investor Motivation. Welcome, Amy.
Welcome, Robert. How are we today?
Going well, thank you. And yourself? What's news?
Not much. Got an early day today, so a bit excited for the weekend. Might be in a chirpier mood than usual as I'm looking forward to going to the footy tonight and just being in Melbourne for the weekend.
Collingwood and Brisbane, is it?
Yeah.
Awesome.
So my team and Cody, my partner's team, going head to head.
Fantastic. Well, that's hopefully for a close game.
Yeah.
And it should be cold down there, so ring up.
Yeah, in Marvel, so if it rains, it doesn't matter.
Okay. The roof will be on.
Yeah.
Thank you very much for joining us. This week we're going to have a chat about, so Amy, myself and the advice team, there's 5 of us in our small little business here. We went to Melbourne last week and we caught up with a guy that I class as my mentor, and that is Peter Thornhill.
Yeah, we did. It was on a Sunday. We made a weekend of it and made lots of learnings on the way, so we thought we'd share them all with you.
Yeah, so very unscripted. This is, I suppose, investment philosophy, and it's not just about how to invest, but it's also about, how to retire well, how to, make sure that you focus on what's important. And I first saw Peter 22 years ago now, again showing my age, which I always do, but he was really so far ahead of his time in terms of conveying the message of I suppose a philosophy, a way to invest and why, but also on what's important in retirement. And his delivery has always been quite exceptional. So it's always been a key part in the way that we educate our clients. It's been guided by Peter's work in the past. And more often than not, when we have a client come in and we're talking investment, we provide them a copy of Peter's book, which is Motivated Money. For those that are viewing on YouTube, there it is. So we use that, and a lot of his information is a core to obviously what we believe in and what I've done personally over the years. So
it has shaped our business's investment philosophy.
Correct. So for me, this is not just theory, it is practical. It's what I've done for myself and my family personally. It's how we've invested. But before we kick in, Amy, the acknowledgement of land, please.
On behalf of the Investor Motivation podcast, we would like to acknowledge the traditional custodians of the land on which we record this podcast and pay our respects to elders past, present and emerging.
Cool, thank you. Now, where should we start with the day?
I think Peter himself, accumulated his wealth over his lifetime, but he admits that he didn't start with a lot. And I think the number one and first lesson he wanted to show, especially the younger group in there, which was me that day, was, spend less than you earn. Our generation is extremely, hungry to be in the final position now. We want things now, even though it's taken, previous generation a lifetime to accumulate those things. So that's a really, really massive learning, and it's going to take a lot of drilling into my generation's mind, but it is spend less than you earn and borrow less than you can afford.
Which is often less than what the bank will allow you to.
Yes.
So these are what he calls his golden rules of wealth creation. And they're simple, but if you don't spend less than what you earn, you don't then get to talk about what do I do with the money that I've saved and how do I invest that. So without getting golden rule number 1 right, you're snookered. You don't get to have the conversation about where should I invest.
If you can't accumulate any money, you've got nothing to invest. So.
And obviously borrowing less than you can afford is very much around, although not taking on too high a debt load, which then snookers cash flow and the ability to build wealth.
Just because the banks will they'll tell you the maximum number you can afford, so borrow less than you can afford, take a fair bit off that and give yourself a bit of breathing room and more ability to accumulate money.
Yes, which might mean some people start in a slightly not as new home or a smaller home than what's probably been happening in the last 20 years.
Yes.
And we probably need to acknowledge that Peter has been in the industry for a long time. He's in his mid-70s now. He's had the benefit of spending less than he can afford, spending less than he earns and borrowing less than he could afford. He's been a benefactor of that, but he's a different generation where it was probably more conservative thinking many years ago.
Yes, definitely. That the generation above was much more frugal with their money and more purposeful with what they were spending on, I think.
Yep. And we're just running through some of his core notes here as we go along as our reminders. But he spends, obviously, there's a lot of time on the psychology of money, but also the terminology to understand what is investing. And he's an amazing guy who's forever cutting out newspaper articles on, and the examples he had were, 2 luxury handbags. I think one was about, I forget the brands, 10 grand, and then there was another delicious crocodile handbag,
crocodile skin,
$44,000, and in both the ads actually mentioned the term invest.
Invest in yourself and buy this beautiful handbag. It'll appreciate over time, or
transcend generations and invest. So essentially, he was really questioning, the term is used so loosely that. And this is where he goes back and has a look at the actual definitions, and the best definition that he found was actually within the Modern Encyclopedia for Children, where we quite liked it, where it said, to use money productively so that regular income is obtained. That's investing.
He pretty much cut through all the noise and said that should be the true definition of investing. Not, investing in a handbag for yourself.
Yes, yep.
Generate nothing.
Yeah, and then he obviously split up the difference between people that are, say, trading, particularly cryptocurrencies. Unsurprisingly, Peter's not a big fan of the crypto world.
He's quite a theatrical person. He did a big spit on the ground to say crypto.
Yeah, and so. Yeah, speculation, day trading, obviously into assets like crypto that has no value in a way. What does it do? For me personally, the best way that I describe crypto is that I'm not going to be paying someone for a figment of their imagination. It hasn't solved any of the world's problems, so why is it worth? Well, you might say supply and demand, but geez, you're still speculating. Yeah, it's the greater fool theory. You just hope that someone's going to pay a higher price than what you paid in the past. So speculation, day trading, things like that, he's saying that is not investing.
No, and he found the definition that spoke most to him for speculation was to buy goods or stocks expecting them to sell at an abnormal profit. So there's no guaranteed growth, or it's just speculating. You think that it will rise in the future.
Yes.
But there's no way to value that.
And I suppose at its purest form, what Peter is doing is investing like a Warren Buffett. Buy and hold, find businesses that will appreciate and grow their revenues and profits over time, backing human endeavour. And if you do that over a long enough time frame, then that's going to provide the results. And Peter has data back all the way to late 79, and he often calls, one of his slides is called the mothership, where he's comparing the All Industrials Index, so the Australian Stock Exchange excluding resources, because he has done the research to show that resources over a long period of time underperform resources. And that's probably a number of reasons. The capital expenditure to get a mine going is high, and then the ability for these businesses to, I suppose,
the pricing power behind their
correct. Can they say, look, that's right, they've got no pricing power, is what I was searching for, and that obviously affects profitability. It's not saying that people haven't made money out of resources, or term deposits or property. It's just that Peter is so focused on which asset class will provide him the best result compared to all other asset classes.
So he has done the research all the way back to, 1970 something?
79.
So 1979, and from that point onwards, it has outperformed. So there is data behind everything that he says. It's not that resources haven't performed well, it's just compared to what?
And that's one of his classic lines where, and that's something that stuck with me back in 2001 when I first saw him on conference on the Gold Coast, with a financial planning group was the barbecue talk. I've done well, and he goes, compared to what? That no one is benchmarking themselves. And just looking at one of his slides here, and this is 100 grand invested from 79 to 22. It's comparing all industrials index compared to the all resources, and assuming that over that time that the income has been taken out and used, that the all industrials is about $2.07 million, and the all resources is 1.35 mil. So that's
double.
It's $710,000 difference over a long period of time. And it's interesting. It was only yesterday or the day before I caught up with a client who received her inheritance, and so she's got very well to do. She won't need to worry about money, but in her father's portfolio, which she inherited, the assets weren't sold. She just inherited the shares, and it was
the cost basis and everything.
Inherited the cost basis. So we rebuild these portfolios back to the day they bought them, and within it was a fully Aussie equity portfolio, which is normal for a lot of inherited portfolios. But there was out of probably 13, 14 holdings, there was 5 or 6 10-baggers. And a 10-bagger is when the company has gone up by more, tenfold or 1,000% or more. And one was sitting just under 2,000%. CSL was definitely there at about 1,400%.
Wow.
But her dad didn't buy at the float at 80 cents. The cost price was about $8. So imagine the multiple then if he got in right at the start. So that's essentially what Peter's done, what I've seen in a lot of mostly inherited portfolios.
Probably the next biggest topic that Peter did bring up with us was, he's really great with grabbing those newsletter articles and the highlights on a day, but he had one example where on one given day it was a screenshot of his Yahoo Finance account, and it had one newsletter article that said, based on overnight economics, expecting the share market today to increase by, a large percentage, and then down the page a little bit longer, based on overnight economics, share market today is expected to fall by da-da-da-da.
So completely contradictory.
Completely contradictory, but just highlighting the fact and the influence that the media has on share market volatility and consumer sentiment. So our analysis of the market as consumers, I guess, based on the information we see every day, we feel a certain way about the market, and then the market will react based on our emotion.
Right, and he was very good at making that point, Amy, to say the share market is made up of the participants. That's us. It's humans. It's people making irrational decisions more often than not around the market. So markets tank. I'm scared. I'm now nervous. And I sell. Or markets have done really well over the last 12, 13 months. Let's get in, and you're buying with greed. So he made that key point that the market, the share market is not some,
It doesn't have a mind of its own.
It is steered.
It chooses its
That's right. It is steered by us and our emotions. And some people, when it hits the fan, when things go terribly wrong, it's tough to make those decisions. And I suppose all the articles, which was so many different articles, that was always negative.
More often there was probably only the one positive one, and it was posted on the same day as a negative, but he had many articles, and it was just all negative, market dominated by fear, and it was just very emotionally driven with fear as the main driver. And that's the media, and that's media selling newspapers and getting people to watch their shows. So essentially, that he had a very good, and if you could imagine a share market graph where it's lots of ebbs and flows, and essentially Peter's saying, stop looking, you invest, you stop looking, you stop mucking around with your portfolio on the short-term basis, and he has
he had the big graph up there which had all the volatility.
Yeah.
He said, well, here's how most people see the share market, from one axis to the next. And then he goes, here's how I see it. It was one straight line from where it was back in 79 to where it is now.
Yeah.
Because he's not worried about the short term.
No, if we have our long-term mindset in mind, we only need to know the value of our asset at purchase price and then again at sale price. All of the in-between, it doesn't matter.
Yep.
It's irrelevant.
And for the most part, he's holding these assets for a long period of time.
Yes. Yeah.
More than likely the rest of his life.
Yeah.
Volatility is a key part, and helping people make good decisions during tough times, I think, is key in a financial planning role. Full disclosure, as Peter said, that he knows his stuff backwards, but he uses a financial advisor, so he doesn't have to worry about it. Mm-hmm. So he can go on holiday with his lovely wife, which he speaks glowingly about,
he does.
And go and do the fun stuff.
Yeah.
I think one other issue it's probably well worth talking about is the tax structure, managed funds, ETFs, and his preference.
Yeah.
So would you like to kick off on the discussion around, obviously, the flaws in the ETFs and managed funds?
Yeah, and we have covered this off on another podcast, so if you're interested in a very deep dive, go check out that podcast, but we'll just touch on it here.
Yeah, well, I think it sort of honed, obviously it's relearnings all the time, but it honed a little bit further for me that, the trust structures have to distribute all income and capital gains 30 June each year.
Yeah.
And this was one of the reasons why I've tended to avoid some of these products, particularly where there's higher tax implications involved for the individual. That you can invest on the 15th of June, and then 2 weeks later you get yourself a big distribution and a tax problem and potentially a Centrelink problem with owning it for an absolute heartbeat. So in a way it's a flawed structure, and because of that, Peter very much likes listed investment companies, which can choose to pay nothing out in dividends if they want. They can choose to pay some out, retain some for a tough year.
Yeah.
And I think there was a great example where dividends went down during a certain period of time where one listed investment company, and we're talking about AFIC, Australian Foundation Investment Company, Argo, Milton, which is now part of Washington Soul Patterson.
Yeah.
These types of, Whitehaven was another that he was very glowing with.
So in the tougher years like COVID, when the investment company is receiving less income from the businesses it has invested in, it has a stockpile of previous really high income years that they can maintain their current dividend payments out to the shareholders.
Correct, and that's one did exactly that.
Yeah.
And he acknowledged that within some of these LICs, listed investment companies, there are some resources, but it didn't overly worry him because he knew that when he goes, that his wife won't need to bother.
No.
It'll be looked after by professional investment managers.
Yeah, that is much more of a retired mindset, that you just do want that income coming in every year. Even on the bad years, these LICs have the ability to continue those payments and boost them if they want to.
Yeah. Now, I think he speaks a lot about yield.
Yes, he does.
So, Amy, take that one off. And I suppose the example around yield versus a term deposit.
Yeah, so, historically term deposits, you receive a
an interest payment.
An interest payment, but let's just look at that as a yield. So you've got your interest of 3%, your yield of 3%. If you have a investment in a company and its yield is 3%, that 3% is valued based on your business's value, whereas a term deposit is a static figure. Mm-hmm. You invest $100,000 into a term deposit, 3% will always be the same figure. Whereas if you invest into a company that's value fluctuates daily and yearly, that 3% is not a stagnant value figure.
So, it can be a percentage. Same. It might be the same percentage on a growing capital base.
Yes.
Whereas and this is, I think he calls this one the mothership, where it's comparing the All Industrials Index to a term deposit. And that's with a lot of the income reinvested over time. And it essentially, I think this is, no, it's with the taking the income out. And it goes all the way back to 1979, so all these graphs go back to the same date, but obviously grow each year. That back in 1980, that if you had $100,000 a term deposit, you probably got yourself $8.5 per year, or 8.5%. Whereas with the dividend yield, you might have got 5.5%. But what it doesn't take into account is that the dividend yield might be only half of the payment or half of the profit that the company received and made during that year.
Yeah.
And they then use the, say they, out of $1 worth of profit, they give you 50 cents, which represents a 3% yield, or a 2%, or a 1%.
Mm-hmm.
They keep the rest and reinvest to make the business bigger and better.
Yeah, and the next year your 2% or 3% is based on a bigger value because they've reinvested into the business and the business value has grown.
So compounding, and what he was actually calling, remember he said double
compounding.
Yeah, so where you took the dividend you got and then reinvested it, knowing that the companies were reinvesting also, double compounding.
Bang, bang.
Yeah, and I think one of the interesting points that, that I suppose that I physically saw as an advisor, that from 2008 around the GFC and onwards, so interest rates went up leading up to the GFC, then they got smashed. And they got smashed all the way down to the COVID event until they've gone up in recent times. So let's say, for example, someone with $1 million in a term deposit in 2008, they may have been getting, so $1 million invested, getting 7%. That's 70 grand.
Mm-hmm.
During COVID, when it got smashed down to next to nothing, $1 million term deposit was not getting 70 grand.
Maybe
Amy?
2%?
Oh, no, far less than that. 0.4, 0.5. Yeah. So there's probably, just to be fair to Amy, Amy's relatively new to the industry.
Yeah.
So didn't really see those times where term deposits for a year or 6 months were 0.2, 3. Yeah, it was incredible. So for that example, $1 million was not bringing 70 grand, but bringing in 5.
Yeah.
And the one note that Peter made was that never made the headlines.
No, you don't. Yeah, the news doesn't, and the media doesn't smash term deposits and what we consider are conservative assets. They just smash the shares and the ones we expect to perform exceedingly well.
Yep. So that was there. That was a really interesting one, and I saw that in practice. It was death by 1,000 cuts.
Yeah.
So that's where we've always said there is risk in being too conservative over a long time frame.
Yes.
But keep in mind that dividend yield is merely a arbitrary calculation or ratio dividing the last year's dividend by today's share price.
Yeah.
Times by 100 will give you the yield. It doesn't tell you anything about what is the business keeping and reinvesting. It doesn't tell you anything about the business.
No.
And Telstra is a classic example of that. They haven't reinvested well, but they've paid very high dividends.
Because the value of the business hasn't grown, so that dividend yield hasn't changed so much.
Correct. So the dividend yields always look good, but in the last 10 years, dividends have actually gone down.
Yeah.
Where I just showed this morning at our advisor meeting, I showed the crew as I was doing my research on Microsoft that their dividend has gone from 10 years ago, 3.2%, down to 0.8.
Yeah.
But the dividend, the actual dollar dividend that we can take and then spend, has gone from 90 cents to, I can't remember exactly, but it might be $2.70 over 10 years.
Yeah.
That's the number that matters.
Yeah,
These
definitely.
profits growing, dividends are growing. So it might be worth, Amy, having a look at, when things go down, the market, Peter loves a good share market crash. He's very open about that. He's always looking for it.
Yeah.
During the GFC, he was pinning his ears back.
Yeah. Obviously, there would have been a lot of those media headlines that were used to absolutely smashing the share market, and he is very encouraging of them to smash the market because, like you said, he's ears are pinned back and he's listening and waiting for the most fear and then purchasing at those times
Absolutely.
when others are scared.
So he's got some classic examples, so I'll let you chat about those ones, Amy.
Yeah, one of the examples he gave us was Wesfarmers. His purchase price back in 2008 was $12.83.
And that was sorry to interrupt, but that was based under a share purchase plan. So that's when, and we were participating in these here at our office as well, where companies were cash strapped. They wanted to strengthen the balance sheet, so they went and raised capital, and they'd always raise capital at a discount to the current share price to encourage people to do so. So the market smashed the share price down, then they gave you a discount, which is the $12.83.
Yeah.
Sorry, Amy, continue on.
That's all right. So, yeah, purchase price in 2008 was $12.83. Total dividends paid was $25.93.
That's since then.
Since then.
Yep.
And from 2008 to now, that is 202% of the purchase price has been returned in dividends alone.
Cool.
So even if the share price was to fall, he's already made 202% of his original investment back in dividends alone.
But what happened to the share price?
Yeah, but the share price didn't fall, and the shares are now worth over 3.5 times the amount paid.
So 3.5 times is in percentage term is 350%.
Yeah,
Cool.
350% growth.
Is there another one there?
The last 12 months for Wesfarmers. The last 12 months for Wesfarmers, the dividend is only $1.80. So you might think of that, as a low figure, but that puts them on a current dividend yield of 14.03.
Which is based on the last purchase price.
Yep.
Yep. So that seems like a high yield. If you go online and have a look now,
Yes.
it won't be 14. But what Peter's done is the $1.80 is divided by
$12.83.
correct the low purchase price.
Yeah.
Not a bad deal.
No.
Is there another one?
Of course there is.
Yes, there is.
So Commonwealth Bank CBA from 2008 purchase price of $26, total dividends paid $51.88, which is 199% of the purchase price being returned from 2008 to now. So if that's not enough for you, the shares are also now worth over 3.9 times the amount paid. So capital growth 390%.
Wow.
Yeah.
Cool. And
if you look at today's dividend, which is $3.85, and then did it at the 2008 cost price, it would be a yield of 14.8%.
Yeah. Forevermore.
Yeah.
Yeah. So these are actual things that happened. It was things that we did for our clients at our business here. We participated in a lot of these rights offering, the share purchase plan, and people were very scared.
Yeah.
Very scared. But for those that did participate and took our advice, it was fantastic.
Yeah.
Yeah.
Paid off in dividends.
In dividends, and lots of them. Really, there's so much to cover and so many angles that Peter had got, but I suppose if we want to wind it up a little bit, Peter is very much focused on not focusing on the short term. He only reads the crazy media headlines because he likes cutting them out and presenting with them. But I would absolutely, he's really laser focused on, do the things you enjoy. Enjoy a full life with friends and family. He really, and this is where he was talking about this. He's not just saying this as a mid-70-year-old now. He was focused on this way back.
Yeah, that's how he's been able to accumulate wealth, is by not spending all of it as soon as he receives it. And he said, the key to happiness for him is envy no one.
Yep.
The key to happiness.
Yeah, it was a very nice way to say it. But focus on the fun stuff. You invest for the long term. But definitely go onto YouTube. On our website there is some of Peter's videos. We'd recommend that you look at that. I think I've told it, investing in the right asset class. By all means, do that. And for those who would like to make a few comments, or perhaps for those who would like to ask us a question about a topic, we've got 2 copies of this to give away, $30 worth each. So
this for the podcast listeners is a copy of Peter Thornhill's book, Motivated Money.
Yes, so we've got 2 books to give away for someone that would like to leave us a comment with a topic for us to cover off in a upcoming podcast.
Yep.
Fantastic.
Let us know.
Good. I think that's enough. Thanks, Amy.
Thank you, everybody.
Cool. See you later.
Bye.
Bye.